Take a look at markets right now. Interest rates are still high, debt levels are exploding, economic uncertainty hasn't gone away, and yet, markets keep going up. Stocks rise, home prices hold, risk assets refuse to break. By traditional investing logic, this shouldn't be happening. So the real question isn't whether markets are strong, it's what's actually pushing them higher. Because once you understand that force, markets start making a lot more sense. Think about this from a normal investor perspective. Let's say a company reports mediocre earnings. 10 years ago, the stock probably fell. Today, sometimes it goes up anyway. Or housing. Mortgage rates doubled, yet prices barely moved in many cities. If markets were purely about fundamentals, that behavior wouldn't make sense. So what changed? The answer starts when you stop asking, what is this asset worth? And start asking, where is money flowing? Because modern markets are less about valuation and more about liquidity. But before we define liquidity, let's make this practical. Imagine markets like an auction. If 10 people show up with $1,000 each, prices stay reasonable. If suddenly 10 people show up with $10,000 each, prices explode, even if the item didn't change. Nothing became more valuable, there's just more money chasing it. That's liquidity. And right now, multiple systems are increasing how much money competes for assets at the same time. You can actually track this through public data: central bank reserves, treasury borrowing, and investment fund flows. This isn't opinion, it's how the financial plumbing works. Start with central banks. During crises, central banks inject money to stabilize markets. You probably heard this called money printing. Technically, it's more complicated, but the result is simple. More cash enters the financial system. That money doesn't sit still. Banks lend it, funds invest it, assets rise. And even when tightening began in recent years, something interesting happened. Markets adapted faster than expected, which forced policymakers to quietly stabilize liquidity again. But here's what most people miss. Central banks are no longer the only driver. Think about government spending like this. When the government borrows money, investors buy treasury bonds. But then that money immediately gets spent back into the economy. Infrastructure, defense, technology investment, energy projects. So money leaves investors and reappears somewhere else, driving growth and asset demand. It's a constant recycling system. And recently, that system has grown massive. Now here's where things start getting strange. Markets today may not rise because investors feel confident. They may rise because money entering the system needs somewhere to go. And that leads to one of the biggest structural shifts investors rarely talk about. 30 years ago, most investors picked individual stocks. Today, trillions flow automatically into index funds. Here's why that matters. An index fund doesn't analyze value. It simply buys companies based on size. So when money enters markets, the biggest companies receive the most buying pressure. Their prices rise. They become larger. Future inflows buy even more. It's a feedback loop. And that loop alone explains why a small group of mega-cap stocks now drives much of market performance. But liquidity doesn't stop with markets. It expands through credit. Most money is created when loans are issued. A mortgage creates purchasing power. A business loan funds expansion. Private credit finances massive projects. Every new loan effectively creates new demand in the economy. And over the last decade, private lending markets have exploded in size, meaning more capital chasing opportunities across assets. So step back and look at the full picture. Central banks stabilizing liquidity. Governments injecting spending. Passive funds automatically buying. Credit continuing to expand. Together, these forces form one engine: global liquidity. And increasingly, liquidity, not fundamentals, determines market direction. Which brings us to why this matters right now. Markets are entering another period where liquidity conditions may shift, tied to funding cycles, policy expectations, and capital flows unfolding over the next several weeks. Historically, these transitions decide whether markets accelerate higher or suddenly become unstable. That's the environment investors are moving into now. This is also why Bitcoin often reacts so strongly. It behaves like a liquidity thermometer. When excess capital expands, risk assets benefit first. When liquidity tightens, they feel it fastest. Bitcoin simply makes those shifts more visible. If you focus only on headlines, markets look unpredictable. If you track liquidity, patterns start appearing everywhere. That's how institutional investors increasingly think about markets. If this helped clarify how markets actually move, you can use your weekly YouTube hype. It helps videos like this reach people trying to understand what's really happening beneath the headlines. And I'm curious, do you think markets today are driven more by fundamentals or liquidity? This is one of those ideas that completely changes how you see markets once it clicks. Because today, the real question isn't what asset wins, it's where money is being pushed next.